Hello, everyone. A very good evening to all our participants present today. I hope you and your family are safe during these testing times. I am Nirbhay Morzaria, and today we have with us Siva, who will take us through the presentation of our latest offering, Axis AAA Bond Plus SDL ETF. Siva, of course, needs no introduction at all, and he's a veteran and a very well respected voice in the fixed income space. As head of fixed income at Axis Mutual Fund, he has managed to run this ship successfully for many years now. Uh, but before we get into the insights by Siva on the Indian macro environment and why this strategy is suitable for current times, I would just like to take a moment and set the ball rolling with respect to the product. The product that we are here to talk about today is the Axis AAA Bond Plus SDL ETF. This is a differentiated offering not only from our point of view, but also the industries. This is the first of a kind offering in the target maturity ETF segment. So, what are target maturity ETFs? As fixed income investors, we are used to the idea of investing in FMPs. Uh, a target maturity ETF is a portfolio designed to work in a very similar fashion to a FMP, but with the added advantage of an investor not losing their liquidity. This is because in an ETF structure, the investor has the flexibility to enter and exit at any given point in time, and the unit that is because the units are traded on the exchange. The product comes with a portfolio which will mature on a predefined date, and the fund manager will achieve this by buying securities with similar maturities closer to the defined maturity date and will hold them to maturity. So for the purpose of understanding, we can consider this to be like an open-ended FMP. For Axis AAA Bond Plus ETF, SDL ETF, the fund has a 5-year defined maturity, and all the papers in the portfolio will mature on or before 30th April 2026. So with this, I will now hand over the floor to Siva, who will take us through the macro picture and why investors should consider this strategy in the current environment. Over to you, Siva.
Thanks, Nirbhay. Good afternoon to all of you. I hope, as Nirbhay said, that you're all doing well. It is indeed a very difficult environment that we are facing as India goes through this extraordinary second wave uh, of COVID. So I hope all of you are doing well, your families are well, and it's also important to look at the impact that COVID is having on financial markets through the impact it has on real economy. Last year, we saw one of the worst economic performances in India. In fact, practically the first negative GDP year going back to the 1980s. It's an extraordinary situation. And extraordinary situations also call for extraordinary macroeconomic policies. Nirbhay, can you skip ahead, please? As I extraordinary negative or extraordinarily challenging growth environment calls for extraordinary macroeconomic policy. What happened last year, as you can see from this chart, is quite extraordinary. A very, very sharp collapse in economic growth, especially in the first quarter, that is the June quarter last financial year. As we came to the end of the financial year, though, it did appear that we were over that difficult phase and we were going back into a positive growth trajectory. Much of what we see around us, started to get normalized by the end of last calendar year. And as we started the new year with the promise of vaccines, it did look like the economy was roaring back into action. Why is this important? It's because, as I mentioned, the policy environment, fiscal policy, that is the policy that the government faces in its budget, and more importantly for us in fixed income, the RBI's monetary policy, were to a large extent driven by this extraordinary fall in growth last year, or fall into a recession last year. We saw the RBI cut interest rates. The official repo rate was cut down to 4%, and the actual overnight rates are hovering closer to 3%. We saw the RBI adding extraordinary amount of liquidity into the system. And they came up with schemes such as the moratorium and asset reconstruction or basically loan restructuring. And the government itself came out with various schemes, including the production-linked incentives, increase in spending on capex infrastructure, and increase the budget deficit. But as I said, as we go into the new year, the optimism which was driving growth also means that we need to relook at a lot of these, especially the monetary support. The point is very simple. The more that the economy is repairing itself, the more that the government is doing to support the economy, the less that the RBI needs to do to support growth. And indeed, what RBI should be focusing on is inflation. Through last year, inflation ran uncomfortably high. Next slide, please. The RBI's official target for inflation is to keep it in a band of 2 to 6%. For most of last year, indeed 11 out of the 12 months last financial year, the actual inflation was higher than 6%, in an extraordinary situation that we had significantly higher inflation than what was allowed or what was indicated by the RBI. As we go into the new year, it does appear that the forecast for inflation is that inflation remains below 6%, but a far cry from the closer to 4% average that we have been for the previous 3 or 4 years. The RBI's target, while it's a range of 2 to 6, the target is to keep closer to 4%. Why? So these two factors are extraordinarily important when it comes to understanding what the RBI will do. First, as I said, as growth improves, and despite the current quarter's pain, if you take a view as RBI should 4 quarters ahead, it does appear that growth will come back, supported both by natural growth as well as higher deficits and higher government spending. Second, inflation is running significantly higher than 4%. As inflation runs high, the RBI policy, we need to go back to normal. The policy environment has been extraordinarily easy with very low interest rates and very easy liquidity. Consequently, over the next 3 or 4 quarters, maybe even longer than that, we should actually expect the RBI to reverse this and start tightening monetary policy. And some steps to this end has already been announced. The RBI in January announced a program called the Variable Rate Reverse Repo, which they expanded in the current month's monetary policy, that is the first week of April. In addition, they have already started increasing the cash reserve ratio of banks, which again removes liquidity from the system. Nirvana, next slide. These steps, the use of the variable rate reverse repo, the VRRR, essentially increases interest rates at the shorter end of the yield curve. But what the RBI found is that when you raise the interest rates at the shorter end of the yield curve, interest rates across the yield curve also start to go up. So we saw a significant rise in yields, let's say for longer tenor bonds, such as 5-year and 10-year bonds, even though the RBI itself was acting only at the very short end, closer to the overnight interest rate. So in April, when they announced an increase in the VRRR and other steps to normalize monetary policy, they also came up with a program called GSAP, the Government Securities Acquisition Program, which in a sense aims to keep the longer end interest rates relatively stable. So in a way, to raise the shorter end of the yield curve while keeping the long end of the yield curve relatively anchored. This is a new program for the RBI. It's called yield curve control, and the RBI governor called it reducing the term premium. The term premium refers to the spread between short-term interest rates and long-term interest rates. Effectively, they want to slowly increase the short-term interest rates, but reduce the spread between long-term and short-term interest rates by holding on to the level for long-term interest rates. As investors in debt markets, this presents very interesting and unique opportunities. Firstly, and ordinarily, you would think that a rising interest rate environment is bad news for bonds because, as many of you would be aware, bond prices are inversely correlated with interest rates or yields. That is to say, as the yield on a bond rises, its price falls. So there is an opposite or inverse relationship between the two. Therefore, as one expects interest rates to go up, the fear is that bond prices will fall, and this can hurt the NAVs of our funds. But here is the RBI, which says that here I am trying to protect long-term interest rates. I'm actually holding the long-term interest rates stable. And in fact, they've quite successfully done that. Over the last month, yields on 5-year, 10-year, and longer dated securities have actually declined, in spite of the fact that the RBI indicated that they would be increasing the VRRR. Part of this, of course, is because of the current COVID situation. The market's worried that this will lead to further decreases or deceleration in growth, which means that the RBI will be, will take longer to normalize monetary policy. To be fair, that's a very, very likely outcome. But also the impact is just the RBI own coming out and saying that we will purchase large amounts of government securities. In the first quarter alone this year, that is between April and June 2021, the RBI intends to buy about 1 lakh crores of government securities through this GSAP program. So effectively, the RBI is signaling that even though short-term interest rates are going up, actually long-term interest rates is not expected to really go up. That's the context we are living in. We are living in a context where growth is going to be affected in the near term because of COVID. But when you take a look at the medium term, a lot of positives that we see in terms of normalizing growth, and therefore we should expect the RBI to do more in terms of normalizing interest rates. These steps that the RBI took and the market expectation of normalization of interest rates over the last 3 months has actually resulted in a significant shift in the market, in market interest rates, especially for the short-term bonds. Rbi, next slide. Next, please. The movement slide, please. Nirbai, I need to see that bar chart.
Okay.
Yep. So what really has happened is, and as RBI has come out and announced these tightening or potential increases in interest rates, we have seen a significant increase in yields of bonds across the yield curve. This bar chart represents the increase in yields across various parts of the yield curve from 31st December to 31st of March, 31st December 2020 to 31st of March 2021. Yields are slightly these levels are slightly lower today than it was on March 31st, 2021, but it still gives quite an accurate picture of what's been happening in the markets. So what's really been happening is very interesting. At the very short end of the yield curve, which is to say 1 year and 2 year bonds, yields have risen by 20 or 30 basis points. Not much, very small action. And very interestingly, at the very long end of the yield curve, 15 years, again, yields have only moved up by 30 basis points. Most of the negative action has actually happened in 3 year and 5 year bonds, where yields have gone up by 50 to 80 basis points. This very large sell-off presents a very interesting opportunity, because the RBI is actually coming and purchasing these 5 year, 10 year and longer dated securities from the market. In essence, the RBI itself is signaling that we think that the yields have gone up too much. This rise, and especially in the 5 year segment, is the reason why we have this fund being launched today. We see that as a very interesting opportunity where a lot of negativism has already happened and yields have risen significantly. Today you have a very unique situation that despite this rise in yields, the spread between different segments of the market has actually behaved quite differently. We will wait for a moment while we get, I think we have a technical issue, we'll try to get the chart back up. But in the meantime, I'll continue and we'll hope that we can get the chart back up. But in essence, what has happened is that the fact that 5 year yields have risen significantly more than, for example, 10 year yields, means that the spread between 5 and 10 year, the term premium between the 5 and 10 year has come down. This is part of what RBI governor was talking about, that he wants to reduce the term premium. The term premium between 5 and 10 year securities has come down, but the term premium between, let's say, 3 and 5 have actually not come down, because both of them have risen by about the same amount. Consequently, the 5 year is in a very sweet spot. Between 3 and 5 year, yields are at record highs. So if you were to buy a 3 year bond today versus a 5 year bond, the incremental yield you get is at a record high level. But if you were to go from, but that is more in line with normal market conditions. Rebecca, can you go to that yield movement chart, the 3 cross 5 and this one, yes. So in these two charts, what you actually see that on the chart on the left is the spread between 3 and 5 year AAA bonds. That is to say, the higher yield you get, highest, in fact, more than 10 years, you need to go back probably 12 to the global financial crisis before you see anything like this. 10-year spread. So the incremental yield you get from 5 to 10 year is not actually very exciting. So what's actually happening is you have a situation where the 5 year is actually an outlier in terms of its position in the yield curve. So we really like that segment. I mean, I do, if you ask me, I mean, yes, there's an opportunity. Is there an opportunity in buying 10-year bonds? Yes, of course there is. But given the current market environment, I think this is an interesting opportunity for investors. It's also important to understand how this works in a rising interest rate environment, because as I mentioned, if yields go up, then you have a challenge. That is to say that you have a possibility of losing money if yields start to go up. So we did that analysis also. So we looked at scenarios and what happens if yields start to go up if you are buying a 5-year bond. Now, Nirbai, the scenario analysis page, please. The next slide. Yep. If you hold a bond, which is a 5-year to maturity bond, all the way to maturity, it doesn't matter what happens to the interest rates in 5 years' time, because, well, your bond will mature. It has no duration risk at the end of 5 years. So consequently, if you look at this table and you look at the 5-year returns, whatever your starting yield is equal to your 5-year returns, because it's a single bond, 5 years, straightforward calculation. But let's say if you look at it at the end of 3 years, then what happens is, because of movement in yields, you may end up with a return what's called marking to market. So we looked at different scenarios. What happens if yields move up and down by 25? Let's forget about the yields moving down. I mean, we are in a rising interest rate scenario. Let's look at what happens if yields were to go up. What this chart essentially tells you is that even if yields go up by 25, 50, or 75 basis points, your effective returns over 3 years is still going to be between 5 and 575, or 475 to 575. Today, if you were to buy a bond which is exactly 3 years to maturity, you'll probably be in the 5-quarter range. So what that suggests is that even if yields rise by 25, 50, or 75 basis points, by holding a 5-year bond, the returns after 3 years is roughly going to be the same as, or maybe slightly better even, as compared to holding a 3-year bond. This is extraordinary. In a rising interest rate environment, therefore, actually it makes more sense to buy a longer duration bond than a shorter duration bond. This is because of RBI's two parts. One is because the yield curve is very steep, and because the RBI is acting to cap or to hold on to longer term interest rates. So the RBI actually manages, in fact, if the RBI is successful, the yields may not rise at all, in which case, of course, significantly better off owning a 5-year over a 3-year bond. We see this as a very interesting product from that perspective. Also, remember very importantly that when you are looking at today making investment decisions in fixed income, one key challenge over the last 12 months has been to find products where yield is somewhat better, or something gives you better returns or expected returns than inflation. Inflation projected to be, let's say, 5% for the next year, but let's say between 4 and 5% for the next few years. The challenge has been to find bonds which are significantly better than that. So in the current environment, you're getting 5-year AAA and state government securities at closer to 6%. That's a decent spread over expected inflation over the next 5 years. In the course of the last year, most of the time we saw inflation at 6% and yields at maybe 5% or even below. So even from an investment objective of being able to deliver something which is better than inflation, we see this as a very interesting opportunity. So if I can summarize what I've said so far, the macro environment is, the outlook is a little muddied for this quarter because of COVID. But when you take a 4-quarter view out, I think the macro environment is looking a lot better. Consequently, we should expect interest rates to go up. And therefore, we need to find products which can protect us from those rising interest rate scenarios, or which actually benefit from a change in the RBI's monetary policy. Most importantly, this introduction of this new government securities acquisition program, which is aimed at keeping long-term yields relatively stable. And therefore, we are sort of launching this fund We'll get into a little bit. I'll get Nirbai to comment to talk a little bit about what makes an ETF an ETF and how it's different from a normal mutual fund. But essentially, we are looking at this as a way for investors to invest for medium term. So let's say 3 to 5 year holding periods in a product which is essentially very, very high credit quality. By design, the index that we have chosen is 100% in AAA and state government securities. State government securities are not the same sovereign risk as central government securities, to be sure, but they are sovereign securities at the end of the day. So very, very high on the credit quality side, and essentially it's like what we used to call FMPs in the past, fixed maturity plans. This is a target date fund. It has a date that, as Nirbai mentioned earlier, 30th April 2026. So in a sense, it behaves like a fixed maturity plan, but it has got slightly different conditions because of its ETF nature, exchange traded nature. So we'll get into that in a moment. I see this as a very interesting opportunity. I'll get Nirbai to come in over the next few minutes to just discuss what an ETF is and how it's different, and then we will do some questions. So Nirbai, can you take over here for this part, please?
Thank you so much, Siva. That was very interesting with respect to the Indian macro environment, and also why such a strategy at this point in time is an absolute fit for an investor's portfolio. What I'll quickly do before getting into the Q&A part of the webinar is I'll just take a few moments to just run through a couple of slides to just solidify as to why this strategy is making sense. Siva talked about the investment thesis and the broader environment. Just from an investor's portfolio, debt portfolio point of view, like in an equity portfolio, we have core strategies and satellite strategies. In the fixed income buckets, we have strategies which are liquidity based. Some can be your core allocations and some can be your satellite allocations. So from a liquidity point of view, you have your liquid funds, your low duration strategies, which investors can use from the liquidity point of view. A satellite allocation is nothing but a play on the interest rate as well as the credit rate, environment in the economy. And there is a core allocation. So the core allocation is somewhere where an investor is planning to hold these kinds of strategies for a longer point in time. So a short bond strategy is a good example where there is a lower interest rate risk involved, and a strategy like this fits in perfectly because given the the duration of the portfolio, this will be an ideal fit from a core strategy or a core allocation from an investor's debt point of view, debt portfolio. Why do we think it is a good mix of investing in an individual bond and a combination of an actively managed debt mutual fund? What we've done on this slide is just put out some of the key parameters that we would use to track a debt portfolio. So this table will just very well differentiate and highlight why this strategy is again the right fit for you from an investing point of view. So if you look at the return trajectory, like Siva mentioned, it's an FMP kind of a structure with the added advantage of liquidity. So from a return point of view, you are more or less certain plus minus here and there. So obviously, while we don't guarantee or can't give you an exact number, depending on where interest rates are currently, you can come to an indicative yield. From a liquidity point of view, that is the biggest advantage which we feel is available with this product. Liquidity, because it's an ETF structure, because it is listed on the exchange, investors can trade it on the NSE as well as come to us if there are units which are 25 lakhs and above. So both the options are available. Diversification from a portfolio point of view, the underlying index has 12 entities, 6 on the AAA side, on the private side, and 6 which are SDL. So it's a good mix in terms of the portfolio diversification as well. Professional management, I don't need to highlight too much there. Defined maturity, like I mentioned, the product is going to mature on 30th April 2026. So it has a defined maturity. So investors who have a specific goal in mind can look at this product from a fixed maturity point of view as well. And the biggest advantage we feel that the portfolio has with respect to individual bond investment is the tax efficiency, because the underlying portfolio has exposure towards SDLs. The indexation benefit is available, and this only enhances your overall return using the indexation benefit. So just to take the previous point forward, as to how the power of indexation works, just there is this comparison between a traditional savings scheme and a AAA bond. So what we've done is just taken an assumption based on the rate of return which is currently available in the market. So on your 5-year traditional savings scheme, so while the return profile is the same, the biggest benefit comes in the a post-tax return segment. This is because you see a 1.5% difference purely because of the indexation benefit which is available with this product, which is not available in your traditional savings scheme. So with this, on a compounding basis, a 1.5% goes a long way, and can be quite attractive for investors who are looking to beat traditional fixed income instruments and saving schemes. So to summarize what we've spoken about in the last half an hour, the opportunity is something which Siva covered in detail, and we saw in the slides earlier as well. Core allocation is something that I spoke about, where an investor with a fixed investment horizon of about say 5 years can consider it as a part of the core allocation. The mechanics when it comes to an ETF structure, because it is an ETF and because it is replicating an index, it is low cost in nature. So that is one added advantage. And because it is on the exchange, it is easy to trade as well. And the last but the most important point is that it comes with an indexation benefit of about 5 years, of about 5 years, because the product is 5 years in duration. This will be a nice complete package for somebody looking at an investment of 5 years from the current point of view. So with this, I will want to open the floor for Q&A. I would just take a few moments for investors. You can use the live chat box which is available with us. You can type in your questions, and Siva will be more than happy to answer the questions that you have. So we'll just wait for about 30-35 seconds, post which once the questions start flowing in, we will take it up one by one. Siva, we've already started receiving a bunch of questions, and a very interesting couple of questions from the market point of view as well. One repeated question which I can see on the chat screen is, how is this fund different from the Bharat bond scheme which is currently available in the market?
Yeah, it's not going to be too different. At the same time, it is going to be slightly different. So the way the Bharat bond is defined is that the index is essentially determined on the basis of the government's in a sense, it's like the erstwhile how they did the divestments, etc. So it fits into a public sector agenda to try and raise funds for PSUs, and therefore the constituents of the index are purely public sector companies. So in our case, it's a AAA, so it's not limited to PSUs. So we have 6 corporates, as you mentioned. 5 of them are PSUs, and 1 is a non-PSU entity, and 6 issuers are state government securities. So there is a difference in the composition. There's not too much of a difference in terms of credit quality. Even the Bharat bond is a AAA product after all. So it's not going to be a huge difference. And of course, there are choices that has been made in terms of the maturity profile. As I mentioned before, for us, the 5-year segment looked most interesting. And of course, the Bharat bond, as far as I'm aware, it's quite a bit longer. So in terms of holding to maturity, for example, it is a much longer period, I believe. The idea is to create a product which has somewhat of a different mix, keeping the quality very, very high, but not limiting purely only to PSU companies.
Okay, great. I hope that answers a lot of our investors' questions, as you know we've been receiving this question a lot in the chat. Another interesting question which has come along is how is this a better debt proposition compared to other offerings which Axis Mutual Fund has currently? It's a very good question, and
it is an exceptional. It's a very good question. And in fact,
yeah.
the way I look at it is that it is a very different product. We offer are actively managed, which means the fund managers are constantly evaluating and changing the portfolio in response to market conditions. And investors come and go at different points of time. In a closed-ended fund or in a target date fund, what happens is investors come in and, more importantly, they go out at a specific point in time. So all the investments are made so that the ending dates are close to predefined. So in this instance, we know that the target date for this index is 30th April 2026, and all the bonds in the index mature on or before that. So to that extent, it creates a lot more clarity in terms of what the product is. It's like I mentioned earlier, closest analogy is like an FMP in a fixed maturity plan. It's like a fill it, shut it, forget it. So you start off, you put the portfolio together, and then you hold it to maturity. Of course, there are minor differences in an ETF versus an FMP because of potential inflows and outflows. Therefore, there may be minor changes. But in essence, you as an investor know exactly which are the 12 issuers which are in the portfolio, and you know what the target date is. Therefore, you know what roughly the maturity date of all those bonds are. That's not the case in an open-ended fund, where we actively manage trying to, in a sense, outperform the market. So now, happy to report that we've been quite successful at doing that as active managers. We're really good at it, but it's a very different type of a product. So therefore, we are saying that if you, when you look at, for example, building your own portfolio of mutual funds, of debt funds, you should probably start with probably a short-term fund, which I've always advocated as perhaps the bedrock on which you should always build your debt portfolio. But for many investors, if you do have some kind of clarity about the holding period, suppose in this instance, it's a 5-year holding period, you have some clarity on the 5 years, and 2, you want some relative certainty about what the returns will be. It's all relative certainty, but still relative certainty, as opposed to an open-ended fund where the calls made by the fund manager will lead to some deviation. Hopefully, better returns, but not always the case. So it's a different product from that perspective, and like an FMP, it makes sense to have as part of your portfolio when you know exactly what, or at least by and large, what tenor you want to hold for, and the kind of names, etc. So to have a clarity on that upfront. I will make one last observation here. Even though this is a target date fund, it is not a closed-ended fund like an FMP. So this is listed and it will be traded on the exchange. Therefore, of course, if you do want to add on to this or to exit at some point of time, that liquidity will be available on the exchange. So, of course, very, very easy to do in an open-ended normal debt mutual fund where there is NAV related liquidity at all points of time on a daily basis. So it's a different product. We are very happy to have clients come in either or both. And I would say that if you're really looking to build a debt portfolio from scratch, my recommendation always would be to start with a normal open-ended short-term fund and look at these products to give you a very different performance profile as opposed to a normal open-ended fund.
Okay, I hope that was very comprehensive for Rahul, who asked us that question. Another interesting question which comes from Pradeep is, how does this product mitigate rising interest rate risk?
Yeah, it's that's the beauty of a target date fund is that the bonds in it are by and large held to maturity. So what that means is, as you get closer to 2026, the duration essentially goes to 0, and therefore, irrespective of where yields are in 2026, the bond you purchase 100 rupees, it matures in 2026 at 100 rupees. Doesn't matter what the NAV or the movement of the prices in between, it will start at 100, end at 100. So as you get closer, it's called pulling to maturity. As you get pulled closer to maturity, the duration essentially goes to 0, and therefore the risk on this, in terms of interest rate risk, also goes to 0. It's like buying a bond on your own. If you were to go and purchase a bond, on your own from a market or in any of the bond issues. You will purchase it, and at maturity, if you hold it all the way to maturity, it doesn't matter what the interest rate risk is. Of course, if you try to trade that bond in between, you are subject to volatility. The idea about a target date fund essentially is to look at that target date and say, okay, am I looking at holding this, or at least you start with the idea that am I looking to hold this till April 2026? You could be plus or minus of that, and in case of emergency, of course, you have the liquidity, in which case the interest rate risk gets eliminated. Now, there's a very small addendum I would like to make here, which is that when you get a bond, you get coupons, which is interest which gets paid out to you every year. The assumption is the interest payments can be reinvested back into the portfolio. At the rising interest rate environment, we may actually get better returns because the coupons may get invested at better yields than you started off with. It's a possibility, but there is no way to know that for sure when you start the product. So we just work with the assumption that the yields will be roughly similar to what the yields are at the start.
Okay, thank you so much for that, Siva. While you've spoken about the fact that this is a AAA portfolio and there are investments in SDLs, there is a very interesting question which has come up, which Praful would like to know whether what happens when a security gets downgraded or there is a default in the portfolio. Very interesting.
Yeah, so it is at the end of the day, it is a mutual fund. Therefore, you are subjecting yourself to some risk. Out of the, as I said, there are 6 government entities, governments. It's not government. It's not government, state government PSUs. It is the actual state government debt. I don't see any challenge there. 5 of the 6 AAA bonds are also PSU AAA names. Again, not that I see any challenge there. And the last one, if you can just put the portfolio of the index up, I think we have it in one of the following slides. It might be quite useful. So as you can see, this is a list of the portfolio. On the left hand side, you have the 6 names which are the AAA names, and on the right hand side, you have the 6 names which are the governments. The selection of this has been made on the basis of which are the securities which are AAA, which have relatively more larger and more liquid bonds outstanding. So this selection is being made by Nifty Indices, which is a subsidiary group company of NSE. So they have made this index. As you can see, 5 out of the 6 AAA names are also PSUs. So I really don't think that this is a huge risk. It is, of course, always a possibility that there is a risk of downgrade or default, but it's a relatively low risk. Now, what will happen if we have a downgrade in this is that the index provider, which is Nifty Indices here, will replace that with another issuer, and so will the fund. So the fund will sell the bond which has got downgraded and will buy the new bond. That could have some impact cost, as there will be some impact of selling and purchasing the paper, but I expect that risk is very, very low.
Okay. Another couple of questions that we are getting is with respect to comparison to other product categories. So where does this strategy stand, say, with a banking and PSU fund or a corporate bond strategy?
Yeah, so as I mentioned, the key difference is active versus passive. Most of the products, such as corporate debt funds, etc., tend to be actively managed, which means there's an active fund manager call being made in terms of the kind of issuer selection, maturity profile, etc. Here, it's a passive product, which means that the fund manager is actually not getting to choose. So this is exactly the list of issuers that we have to buy, and therefore it's a passive product in the sense it gives you, and of course, as an investor, when you before you buy the fund, before you buy this, you exactly know that these are the 12 issuers that's going to be there. So you get a much better clarity in terms of what this fund is going to look like even 3 years from now or 5 years from now, because unless there's a large change in the index, this is going to be the way this fund will look in the years to come. Of course, in a case of an open-ended fund, that there will be changes to the portfolio, etc. The fund manager in an open-ended fund is always looking to beat an index, and an ETF is trying to replicate the index. So there is going to be a very, very different approach in managing these two portfolios. So as I said before, the critical thing is, if you believe that that we at Axis MF are good fund managers, then please do buy our open-ended funds, corporate debt, short-term, whatever you may choose. But on the other hand, if you have a certain target date in mind and a certain specific need, then please do consider this. Both of these are going to have different risk profiles. It's not that they're going to be hugely different, but it will have different performance profiles. Not hugely different, but different enough that you might want to look at one over the other. One last point I'll make here is that in an open-ended fund, also remember there is no target date. So after 5 years, you can keep holding on. In an FMP or a target date fund, the fund will mature and give your money back. So you will still have to make a new investment decision in 2026, which in an open-ended fund, you can leave it be. And as long as the fund is performing, you should be happy with it. So for example, if you're holding for 7 years or 10 years, you can keep accumulating your indexation for that long. You don't have to necessarily come out in 2026. So there are always, I would say, pluses in being in an open-ended strategy. That's always been my belief. But this product gives you a different need. It satisfies a different need. It behaves closer to buying a single bond by yourself, or an FD, or any other kind of a standard traditional fixed income instrument, much closer than an open-ended mutual fund.
Okay, that was great. So in the interest of time, we'll just take a couple of more questions, Siva. One question, you spoke a lot about, the macro environment. You spoke a lot about interest rates and inflation. One question that we've received is a pretty generic question, but I'm sure the viewers would like to know your view on that, as to why are the interest rates of bonds so low at the moment?
Why are they so low? Especially for short-term bonds, they're very, very low because of the amount of money that the RBI has pushed into the system. So currently, the RBI has flooded the system with 8 to 9 lakh crores of excess liquidity. That is, in a sense, the RBI has given more cash than the banking system, or indeed the broader financial system, knows what to do with it. Therefore, if you have more money and fewer borrowers, interest rates go down. So it's plain and simple as that. So you have a sharp fall in interest rates, especially for short duration debt securities. But this is only applicable for short duration debt securities. So, for example, a short-term commercial paper, the yield may be 3.5%. But when you look at outside the short-term commercial paper space, the yields tend to be a lot more interesting. So, for example, a 5-year AAA bond is closer to 6%. A 10-year AAA bond is maybe 6.75. So, and of course, government securities in the 10-year space are about 6%, and 15-year government securities are at about, let's say, 660 to 680. So when you look outside the short-term space, yields are a lot more interesting. But of course, when you look outside the short-term space, you are carrying what's called duration risk. So obviously, you are what the RBI essentially is telling you is that very safe short tenor instruments, the yield is going to be very low by historic standards, very low relative to inflation. So you have to take a call as an investor. What should I do to get my returns up? Should I go longer duration? Should I, for example, go into non-AAA securities? Should I go into a AA or a single A paper, where again the yields are somewhat more, somewhat above inflation? So the push that the RBI is essentially doing is, by keeping interest rates very low, is to actually push investors to take some risk, whether that is duration risk, whether that is credit risk. And of course, money is also found its way into other markets such as equities, etc. With interest rates being so low, people are obviously willing to buy other assets. And by the way, this is not just RBI. Globally, central banks are doing the same thing. By pushing so much of liquidity, they're essentially encouraging investors to invest in other asset classes rather than short-term, high-quality debt. So I think we should, at some level, listen to that. So in a sense, if RBI is saying that I'm going to keep overnight interest rates very low, at let's say 3.5%, and let's say 5-year rates are at 6%, that spread is huge. Then why would I not buy a 5-year bond? And if we can find a way to invest in that 5-year bond without carrying duration risk for the 5 years, like in a product like this, the duration risk, as I mentioned, comes down over the tenor of the product. I think it makes sense. So I'm not sure if I've answered your question why interest rates are low. They are low by design. The RBI has chosen to keep rates low, and essentially forcing us as investors to to make a different decision than to hold short-term high quality debt.
Okay, thank you so much. That was pretty insightful and pretty comprehensive as to as to how the basic dynamics of interest rates work. The last question for the day, and the most obvious question which most of our participants here want to know, is that what is the expected IRR if the investment is made and held till maturity?
See, when you look at the bonds on this in this board in front of you, the average yield across all of these bonds are close to 6%. So that's roughly where the yield is today. Now that is the yield to maturity, so-called YTM of these bonds today, and therefore is also the expected IRR over the term of the fund. In any fixed income investing, please be aware that the IRR is or YTM has certain assumptions in it. As I mentioned, one critical assumption earlier, which is that coupons and other cash flows which come in between the fund will get reinvested at similar yields. It's not too difficult an assumption, but it is an assumption nevertheless, and that can create some differences. Also be aware that there is a small management fee in this, which is very low because it's an ETF, but therefore again there will be some difference between the IRR of the fund and the IRR of the underlying portfolio. But be aware that there will be some differences, but by and large our expectation would be that the return of the fund will be very close to the yield on the index after these small adjustments.
Okay, thank you so much, because that was the most widely asked questions on the chat panel right now. So
I'll echo Nirbhai's statement which he made during the earlier part of the presentation, which is that all mutual funds will never be able to indicate or guarantee returns. This is we can't do that in an open-ended fund. We can't do that in a closed-ended fund. So nothing that I've mentioned today is about guaranteeing returns. But the way to look at a product like this is that if the portfolio is largely AAA or sovereign instruments, as in this case, and the credit risk is relatively low, then there is a higher degree of certainty that the returns will be closer to the yield on the portfolio. That is all that we can say. It's about degrees of certainty rather than a guarantee. So please be aware of that when you're making an investment decision.
Absolutely. Like we say, we don't guarantee returns in mutual funds. So thank you so much, Siva, for the session. It was very insightful. I think you've covered the macro picture very well, and you've also given pretty much all the details that our investors need with respect to investing in this product. So investors, if you have, firstly, we apologize in case of not being able to take your questions today, but investors, please feel free to reach out to the number or email which is there on your screen, and we'll be more than happy to get back to you. Thank you for your attendance today. We hope to be back with you very soon. And lastly, please stay safe and do take care during these testing times. That's it from all of us. Thank you so much for joining, and thank you, Siva, once again. Thank you.
Thank you. Take care. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.